Hello there and welcome back. I'm Sam, and in this video you're going to learn how to identify your investor type. Why is this important? Because knowing what type of investor you are can significantly transform your investment approach and success. Do make sure to share any questions you have in the comment section down below and subscribe to our channel for more insightful content. Alright, so you ready? Let's get into it. First up, let's look at a key distinction in the investment world: active versus passive investors. Active investors are hands-on, constantly engaged in research, buying, selling, and managing their portfolios. Their goal is to outperform the market by leveraging their skills, knowledge, and timing. This approach is often associated with day traders, or those who frequently adjust their investments using tools such as the latest financial news, market charts, and detailed reports. In contrast, passive investors favor a set it and forget it strategy. They typically invest in index funds, ETFs, or broad market funds with the aim of matching the market's overall returns over time. This focus is on minimizing cost and effort, prioritizing long-term growth over daily attempts to outsmart the market. For instance, if you invest in a low-cost S&P 500 index fund and consistently add a set amount of money each month, you're likely to ignore short-term market swings because your main objective is steady, long-term wealth accumulation. Let's continue by exploring other investor types: growth, value, income, index, and momentum investors. Each has its unique style and strategy, catering to different goals, risk levels, and budget size. The kind of investor you become will really depend on what you're aiming for, how much risk you're comfortable taking, and of course, your wallet. Growth investors are all about investing in companies that are expected to grow faster than the rest of the market. Their main goal is capital appreciation, essentially watching their investments go up in value over time. Instead of looking for stocks that pay dividends right away, growth investors zero in on companies that are reinvesting their profits to drive further expansion. You'll often find these companies in industries like tech and consumer goods, where new products, cutting-edge innovations, or expanding markets can really drive things forward. For example, companies like Nvidia and Adobe exemplify this approach as they continually innovate and adapt to meet market demands, positioning themselves for long-term success. Value investors are on the lookout for stocks that are undervalued by the market, companies whose prices are lower than their true worth due to temporary setbacks. This goal is to buy low and sell high, using financial metrics like price-to-earnings ratios to identify strong opportunities. By investing in companies with solid fundamentals and growth potential, they aim for gains as the market recognizes their true value. It's like getting a paycheck without having to work a 9-to-5. Companies like Intel and Coca-Cola are a solid choice for value investors as they offer a reliable income stream and have potential for growth. Notable investors like Warren Buffett have thrived using this strategy, showing that with careful analysis and long-term outlook, value investing can lead to great returns. Next, we have income investors. Such investors prioritize generating regular income from their investments rather than focusing on growth. Their main focus is on creating a steady stream of income that can help support their lifestyle or meet their financial needs. This often means putting their money into assets that provide consistent returns like dividend-paying stocks, rental properties, and bonds. For instance, many income investors love dividend stocks because they pay out regular cash to shareholders, offering that reliable income boost. Companies with a solid history of stable and increasing dividends, such as Johnson & Johnson and 3M Company, are popular choices. Rental properties can also be a great option, as they not only generate monthly rent, but can appreciate in value over time. Plus, bonds, whether they're government or corporate, offer fixed interest payments, making them another appealing choice for anyone looking for steady income. Index investors tend to invest in index funds or ETFs that track a specific market index, like the S&P 500 or the Dow Jones Industrial Average. Their main goal is to match the performance of the overall market rather than just trying to beat it. This approach is all about simplicity, diversification, and lower costs, making it a popular choice for many investors. One of the biggest advantages of index investing is that it allows investors to own a broad range of stocks in one fund, which helps reduce risk. Instead of picking individual stocks, Index investors gain exposure to many companies, making it easy to capture the overall market's returns. Additionally, index funds often have lower fees than actively managed funds, which can lead to better long-term performance. Momentum investors focus on buying stocks that are trending upwards and selling those that are on a downward trajectory. The idea is simple: if a stock has been performing well, it's likely to continue doing so in the short term. And conversely, if it's been performing poorly, it may continue to decline. This strategy is based on the belief that stocks that have shown strong price movements will continue to gain momentum, leading to potential profits. Momentum investors often use technical analysis to identify trends and entry points, looking for factors like price movements, trading volume, and market sentiment. They tend to favor stocks that are experiencing upward momentum, often buying them after a significant increase in price and selling once they see signs of a downturn. Now let's talk about risks. Investors typically fall into three main categories based on their risk tolerance: conservative, moderate, and aggressive. Conservative investors prioritize capital preservation and seek to minimize risks. They tend to invest in safer, more stable assets such as bonds, money market funds, and dividend-paying stocks from well-established companies. Their primary goal is to protect their investment from market volatility, even if it means sacrificing higher returns. This approach is ideal for those who may be close to retirement or who need quick access to their funds. Moderate investors, on the other hand, strike a balance between risk and reward. They're willing to accept some level of risk in exchange for the potential for higher returns. Their portfolios typically include a mix of equities and fixed income investments, allowing for growth while still providing some level of stability. Moderate investors may invest in a diversified set of stocks, bonds, and perhaps some mutual funds or ETFs that align with their risk appetite. This strategy is best for individuals with a longer investment horizon who can deal with some market fluctuations. Lastly, aggressive investors love maximizing returns and often accept higher levels of risk to achieve their financial goals. They typically invest in high-growth stocks, emerging markets, or other volatile assets that can lead to substantial gains and subsequently potential losses. Younger investors usually go for this approach. Aggressive investors are often comfortable with frequent trading and staying updated on market trends to capitalize on opportunities. So what type of investor do you think you are? Are you more of an active investor, always on the lookout for opportunities, or do you lean towards a passive approach, letting your investments grow over time? And do you see yourself changing your strategy in the near future? We'd love to hear your thoughts in the comment section down below. If you like this video, subscribe to our channel for more tips and insights, and I will leave you with 2 more videos that I think you'll really enjoy. I'll see you next time.